Alright, here's a basic overview of the differences between scalping or very short day trading versus swing trading and holding positions for slightly longer, right? Allowing them to run on, let's say, hourly time frames, for example. Alright, so here, for example, the thing with day trading is that what becomes important is very different. So the shorter your time span, the more the technicals matter. And the longer the time span, the more the fundamentals matter. Now, the only extra component there is that in day trading, you want interest, you want catalysts. And obviously, those catalysts can be fundamental in nature, but it doesn't really matter what they are, right? If you're investing in the long term, obviously, you want to know what the catalyst is to be able to judge it in some way, right? That is not really as relevant with day trading. You just want interest, you just want momentum, just have a little bang, sell your position. That's it, right? Okay. So first of all, we're going to take a look at a stock that has very high relative volume at one point. Let's say if you're scanning the markets every day, at some point, this was kind of weird that this happened during the day. But if you caught the stock gaining momentum, you could have gotten in on this when it was suddenly pushing higher with volume. So that is the number one rule in day trading, is that if you have a little bit of acceleration and there's big chunks of volume coming in, right, relative to previous volume, right, so there's a big jump in volume that's going to the moon, and there's already a little bit of price action to reflect it, that tends to indicate that there's a lot of room to the upside. Now, the hard part is being able to time your entries. That is the main skill in this case, right? Let's say on the longer term, your exact entries don't matter as much, right? In the shorter the term is, the more your spreads, how you deal with bid and ask, how you deal with the commissions that you have to pay, right? Selecting the right broker, the right everything, that becomes a lot more important, as well as setting your entries and stops, right? How you deal with that. Okay. So anyway, if you're taking a hold of this at some point, right? You notice there's a gap up. There's a gap up. Maybe that already puts it on your radar based on, depending on what you're actually looking at as a day trader. Then you see the relative volume, and you see a little bit of momentum to the upside. Those are three really good indicators, right? You see RSI in this case, yes, it's above 70, but that's the thing, right? You're not buying discounted stocks. You're not buying on dips here. You're buying on momentum that has an indication that it's going to keep running for a while. That's what you're doing, right? So that is actually the opposite of what you do in a larger time frame. And as you can see here on a larger time frame, not even that large a time frame, like 1 day, you can see, right, that what happens is that this level here, all of the upside is quickly retraced. And you can see that this level here, if we zoom out, what's going to happen with that? Do you think it's going to hold? Well, I'm not sure, but I wouldn't be as confident as to short it, but I wouldn't be at all surprised if it fell back to that level soon after. So, not very confident on it, but that would be very normal, right? It wouldn't be strange. I wouldn't trade based on the fact that it's not going to happen. Okay, so some few important lessons here is that if you're day trading, you're just trying to catch that momentum based on other indicators like volume. You're not looking at RSI as much. You're not looking at whether it's a fair value, a good bargain, right? Because you're not holding it for that period of time, right? You're just catching it in the moment while it's overbought. You're catching that move before it goes back to fair value. When you did lose a lot. It was overvalued, right? Or overpriced. So you need to understand how that impacts your trading. So for example, for a swing trader, you might be looking for a moment to short this, right? I don't know if I would be. It's trying to catch a falling knife, right? Let's say it's kind of a rising knife, right? It's like a bus going up a mountain, as some other trader put it, and then trying to catch it just as it's falling down. Just as it's falling down, you're just like standing there and you're like, yeah, it'll just reverse right in front of my nose. That is a very dangerous strategy because you might just get run over with full force. Like there's nothing telling you that after this doji there isn't a huge up bar again. I honestly, if you could predict that, then I don't know why you aren't a millionaire already. Because hooray profits, leverage the living heck out of your positions and easy money. I can't really predict that. That is the main difficulty of day trading. It's really hard to say anything about that. Okay. What you can say is that, while it has a very strong move like this has a lot of strength, right, with the volume indicated like this, right? Okay. So, second strategy, if you are day trading, now, this might retrace, that this has a lot of volatility, it might retrace all the way back down, right? What you want to do, obviously, is constantly set your stop losses very tight below your current market price, right? So you're assuming this is going to ride up, and as soon as it doesn't, you just just stop the position, and usually it will rise if it has a volume, etc., etc. That's how you make your money. Okay, so the next part is, let's say over here, if you look at the shorter time frames, there would have been a time where it's starting to show indetermination, where you might have the balls to re-enter some of your positions, right? You might set very tight stop losses to the downside, and in this case you would make some moves up again, right? But it's going to be very hard to establish when to stop. So this gets harder. This area gets harder, right? It's more advanced. So if you try to buy dips, you can see that in general that does often work out. So some people, they trade the markets initially in full size, and then they scale down, they scale down, they scale down. Eventually they're all out of it, or they stop their losses on the last trades, and then what happens is eventually they try and buy a dip, right? Dip buying. As you see here, for example, when you see this flattening out, right? If you're just taking very small profits, let's say you see this flatten out and this starts to go green, right? It's breaking this very, 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 very near term level of resistance. Resistance and support slightly different in this kind of time frame. We're just looking at this after the gap up. We're not looking at anything before this, right? It's like a new universe. It's not just a new market cycle. It's like a new universe for the stock. It has nothing to do with what's before this, right? So now you're really just looking at these bars and you're like, okay, as soon as this reaches here, you might take very slight profits, right? I don't know why this gap down, but you might want to make sure that you get out before. Let's see what these timings are like. So here, based on when you exit and how you do this, you could make a little bit of money on these little runs up, right? All right. The thing with swing trading is that if you're swing trading, right, let's say I want to hold this position for a few days, I would never buy it here, right? That's the funny thing about it. It's almost like the exact opposite. I would be more or less bearish on this and presume that any move up is just going to get retraced eventually, and that generally holds true. If you look at the peaks here, right, if you just look at this gap up even, right, it's eventually gone way down, right? So once this stock is rising, like, you can bet your ass, like, after this doji bar, for example, if you the danger of shorting this is that it might continue to run for a long time. Like, it might keep going. So you have a lot of downside risk, which is why it's hard to take these trades, because there's no well-defined levels of resistance, right? So that's why I wouldn't take the trade. But if you did, if you were very risky in that regard, you could make it in a lot of situations. So obviously, as a swing trader, you want to make sure there's levels of resistance that you can use, that you're buying at a discount or shorting when it's overbought. And what you're essentially doing is like almost the exact opposite of what people are doing on the very near term, right? You're saying, well, I think it's going to go back and retrace, but just slightly after this move up, right? Alright, hope that helps contextualize some of the differences, and I'll see you in the next one.